You know this feeling, right? It's that classic founder's dilemma. You've got the momentum, you have the vision, but man, you need capital to pour some serious fuel on that fire. The problem, the traditional options out there often feel, well, they feel like a trap. So here's what we're going to do. First, we'll unpack that funding dilemma. Then we'll get super clear on what revenue-based financing actually is and see how it stacks up against the usual suspects. From there, we'll figure out if it's the right move for your business, and this is crucial, how to spot the red flags so you pick a great partner. All right, let's dive in. Yep, every single founder who has ever tried to raise capital knows this feeling all too well. You feel like you're caught between these two very different and, honestly, often pretty difficult paths. And this number, wow, this number right here tells a massive part of the story. Right now, traditional bank approval rates for small business loans, they're hovering below a pretty shocking 14%. That means the huge majority of ambitious founders are left looking somewhere else. So what are those other options? Well, you've got the banks. It's a slow, bureaucratic process, and they want collateral. Sometimes they even want you to personally guarantee the loan. Ouch. Then, on the other side, you've got venture capital. It's fast for sure, but the cost is incredibly steep. You have to sell a permanent chunk of your company, giving up both equity and control. Okay, so this is where a third option comes into the picture, one that was really designed for the modern economy. It's this flexible model that sits right in that sweet spot between old school debt and giving away the farm. So what is it exactly? Let's put it simply. Think of it like a partnership. A company gets a chunk of cash up front. To pay it back, they share a small, agreed-upon percentage of their future monthly revenue. Once they've paid back that initial capital plus a simple flat fee, that's called the cap, the deal is over. That's it, clean and simple. Let's break that down into 3 really easy steps. Step 1, you get the cash you need to invest in growth. Marketing, inventory, you name it. Step 2, you pay it back with a little slice of your monthly revenue, usually somewhere between 4 to 8%. Now here's the cool part. That payment flexes. If you have a slow month, guess what? Your payment is smaller. Have a killer month? It's a bit bigger, and you pay off the total faster. And finally, step 3. As soon as you hit that pre-agreed total amount, it's done. Payments just stop. The partnership is complete. And this is the real game changer. The single biggest reason founders are falling in love with this model is that it is non-dilutive. Let me say that again. Non-dilutive. You don't give up a single share, you don't add a new voice to your board, and you do not lose control over your company's destiny. You keep 100% ownership, period. Okay, so now we get what RBF is, but how does it really stack up against the old guard? Because, funding isn't a one-size-fits-all kind of thing. It's all about picking the right tool for the job. And this chart just lays out the trade-offs perfectly. Let's look at control. With a bank, you're signing personal guarantees and these restrictive rules called covenants that tell you how to run your business. With a VC, you could get a new boss on your board. But with RBF, those restrictions are minimal. Then there's dilution, giving up a piece of your company. It's 0 with RBF, but it's a huge deal with VC. And finally, flexibility. Bank payments are totally rigid. RBF payments, though, they move up and down with your revenue. And for managing cash flow, that is a massive advantage. You want to see what dilution actually looks like? Here it is. When you take on venture capital, you are literally selling a permanent slice of your company pie. That 25% that the investor now owns, it's gone forever. And that slice is probably going to get smaller with every new funding round. With RBF, that whole pie stays 100% yours. Now, we have to make a really critical distinction here. RBS gets confused all the time with its much more aggressive cousin, the merchant cash advance, or MCA. The absolute key difference is the payment structure. With RBF, payments flex with your revenue. With an MCA, you are typically paying back a fixed daily amount that gets yanked out of your bank account, no matter how much you sold that day. A slow week with an MCA can be absolutely brutal. With RBF, it's totally manageable. And this quote from fintech analyst Jason Miller just nails it. If your funding doesn't breathe with your revenue, it's a liability, not an asset. That really gets to the heart of the problem with these old, rigid payment structures. For a modern, agile business, your funding has to adapt with you. Otherwise, it just becomes an anchor holding you back. And this isn't just theory, right? Check out this real-world example. An e-commerce brand was seeing their ads perform like crazy, but they were burning through cash. They used RBF to scale their ad spend. And because the payments were tied to their revenue, they could go all in on marketing without that constant fear of a huge fixed payment coming due during a slow sales week. And the result?
a 200% increase in revenue.
So this all sounds pretty great, but you're probably asking, is it the right fit for my company? Good question. Let's walk through a quick self-assessment. So the ideal RBF candidate, they usually share a few key traits. First, they have pretty predictable revenue. Think about SaaS subscriptions or steady e-commerce sales. That's because the whole model is based on that revenue stream. They're also usually past the idea on a napkin stage, bringing in at least 10 grand a month. They also need healthy gross margins so that sharing a slice of revenue doesn't cripple their business. And most importantly, they're already growing and they have a crystal clear plan for how this new capital is going to kick that growth into high gear. But here's the thing. As RBF gets more popular, you gotta know that not all providers are created equal. It is absolutely vital that you know how to choose the right partner and avoid the bad actors. So here are 6 big red flags to watch out for. Number 1, opaque terms. If you can't get a simple, straight answer on all the costs, you walk away. 2, unusually high fees. You want to stick in that 4 to 8% range. 3, they don't seem to care about your business's health. A good partner does their homework. 4, inflexible terms. 5, aggressive, you have to sign now sales tactics. And finally, number 6, a lack of knowledge about your industry. At the end of the day, a good provider should feel like a real partner, not a predator. And let's just end on this thought. It's so easy to get paralyzed by the fear of making the wrong funding choice. But in today's market, you know what the biggest risk of all is? It's doing nothing. It's standing still while a growth opportunity and your competitors speed right past you. The right funding isn't just a lifeline. It's a strategic weapon you can use to win.